This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Now, you can't get into a conversation like I'm going to have today with my guest without getting a little controversial. Now, I guess if two people are talking and they are on the exact same page, there's no strife. It's perfectly seamless. But if two people have a slightly different take, they might butt heads a little. There's a little headbutting on today's episode. My guest today is Karen Petrou, and she has a great book out that dives into a subject that should be near and dear to all of us, the Federal Reserve. Her book, Engine of Inequality, the Fed and the Future of Wealth in America. Again, you can't open up the can of worms that is the Federal Reserve without having something unfold that you can't expect, because everyone has a view, everyone has an opinion. And damn it, at the end of the day, the United States Federal Reserve is politics. And once you know it's politics, the issue is who is making the decision to benefit who? Because there's trade-offs in all of these types of choices. One group wins, another group loses. Everyone doesn't win in the great game of American politics. Without any further ranting from me, without any further opinions from me, at least for the moment, let's jump right into my conversation and talk a little Engine of Inequality with Karen Petrou. I look back to my 1990s career, starting a business in my late 20s in the mid-1990s. I saw this huge run-up in stocks. I was in Northern Virginia at the time, so there was AOL was near there and UUNet, all these big tech companies. It felt like vaporware, even AOL. It all felt like vaporware to me. But, look, stocks went up and we had this fantastic bubble. And, when that bubble pierced, we get to the fall of 2002 and I don't know, it didn't really feel like there was a lot of movement in terms of the economy. But all along, the Fed had been trying to get those rates down low. And, now everyone's seen the Big Short movie and they know what happened. We got the rates down low and that caused America to go wild on real estate. And again, we saw the Big Short movie. We get that crash coming into 08, 09, and we get to March of 09. And March of 09, the equity market bottoms. I still don't think anyone except those people that are in the know, perhaps yourself. But a lot of things happened in March of 09 to all of a sudden make stocks start to levitate again. Boy, did they levitate again. We also then got, 10 years of basically no interest income. Then we get ourselves up to the COVID year. We have a little bit of a blip. We're seemingly, to the average person, right back to smooth sailing. And the smooth sailing I would define as this, which is you will no longer ever receive interest income, but you will have the good fortune to just trust us that real estate and stocks will go up. So you no longer get interest income, but whatever morsel you have, throw it into stocks and real estate. Now that works great for, I guess, a lot of people, except young people. Young people said, well, hold on. We don't have any money to do that. So now we're going into Dogecoin. Did I just correctly sum up where we are at this moment in time?
You did, with the exception. I think you did it beautifully, but it's not just young people who are left out of this boom. I think there are other aspects of the current equity and real estate boom that are too eerily reminiscent of 2007, 2008. But the people left out of this boom, like the one that started when equities began their upward march in 2010, are young people, people of color, and anyone who didn't have something to start with. And what you see is what I call the engine of inequality, which is that unless something changes, the richer you are, the richer you get. And conversely, the poorer you are, the poorer you get. In the United States, stocks, for example, are not equitably owned. The top 1% owns 53% of American stocks, and the top 10% owns 88%. So a lot of people are left out. And the home ownership rate in the United States is at its lowest in decades. For African Americans, home ownership in the United States is behind where it was in the 50s, before the civil rights era began.
Let me pause you there, because that's a note that I put down here, that for Black Americans, their economic vitality was greater than before LBJ's Great Society. But if I'm not mistaken, almost universally on the right and the left, less so on the right, of course, that when LBJ's name comes up, Great Society comes up, there's like fireworks, like this was a great thing. But as you note in your work, for African Americans, for Black folks, they've not done better.
It hasn't been, and I think the reasons for that are very complicated. But Black people were always behind white people. What you saw in the Great Society was a combination, a century overdue Civil Rights Act, Fair Housing Act, Fair Voting Act, Equal Credit Opportunity Act, a massive flow of personally called righteous legislation. But the economic policies did not go with them. We had the Vietnam War with tremendous amount of economic dislocation, several profound recessions. Of course, the violence that came along with people pent up anger and economic dislocations in American cities that all served to put Black Americans and other communities of color like Native Americans and immigrant communities farther and farther behind. The engine did not work for them. The economic engine didn't work for them. The justice engine is different.
Let me pause you for a second, though, because I think if we went to West Virginia right now, I grew up in Virginia. If we went to West Virginia, I'm sure there's plenty of white Americans that would have, an economic situation that is not so good.
Oh, yeah, absolutely.
You could probably find that, in all different types of states.
Oh, sure.
I think the issue, when I start to look at your work, and look, we're going to unpack a lot of different things here today. When I start to look at it, look, there's a lot of things, as I describe in my opener. I don't like the idea that no American really has any idea what's going to happen to interest rates. It feels like a casino. So that's one big issue.
It is a casino. It doesn't feel like a casino. It is.
That's one big issue. I think the other issue, though, is that if that's the playing field, if the playing field is a casino, then I think there's got to be an element here. It's double-faceted, multifaceted. We're going to talk a lot today about what government can do, what the Fed can do. But I think there also has to be an individual component. There has to be an individual component. We're not at the Industrial Revolution anymore. This isn't just you can sit back and get a job working for the man and retire with a gold watch. I mean, it's a different world these days. Again, I brought up crypto earlier. I mean, I think young people see that. Young people know it's not the same world. So I think you've also got the generational aspect where each different generation, whatever name we're giving them all, I forget all the ones below me. I'm Gen X, but I forget all the names below me, millennial and whatnot, Gen Z. But I think each generation has its own unique situation. And right now, I think probably the most unique situation for all of us below the boomers, you might be a boomer, I'm not sure, but the unique thing for all of us below you guys is you guys got all the money.
Well, you see, we did for a bunch of different reasons. This is where I might disagree with you. It's not because we're better than you. We're not smarter, we're not better, we're not more industrious. The system worked for us. When I graduated from college in 1975, America had an income and wealth distribution. All countries do. We had very rich people and we had very poor people. First of all, the distance wasn't anywhere near as great between those ends of the distributional curve. Secondly, and I think even perhaps more importantly, people got back what they earned. In other words, to put it more academically, GDP was equitably distributed. If I earned $10, I got a $10 share of GDP. If I earned $100, I got a $100 share of GDP. But dollar for dollar, we each earned that's our share of GDP. In 2018, the last year for these data, GDP, the top 1% got 312% of the share that it equitably got in 1975. And the bottom 50% of Americans worked for them because they did not share in American productivity. They worked, but they didn't get what they, frankly, worked for. That's not all the fault of, in my book, I talk about Fed policy, and I would like to return to your discussion of interest rates, because I think they're a really important driver of inequality that's been largely unrecognized. But there were lots of policies, not just the financial policies after the great financial crisis in 2008, educational policy, putting highways through communities, lower income communities, many, many other aspects of American culture that made the United States the most unequal of all advanced economies starting in the late 1980s.
When you say inequality, we're talking about unequal. Okay, so as a Gen X guy starting a tech business, I saw the internet unfolding in the mid-1990s, and I was like, okay, this is going to change my life. And I made decisions at that moment in time to change my life based on the internet, because I realized, okay, I'm going to have this internet in my 20s. You did not. And all of the data points before me did not. So in my mind, I always look at the summer of 1995, Mark Andreessen Netscape goes public, and the internet game is on. And to me, it feels like a lot changed. So, for example, I don't necessarily think it's a great idea if Jeff Bezos becomes a trillionaire, but on the flip side, I sure as heck don't want to stop, because I think if you start, like if you try to stop a Jeff Bezos at the beginning, if you try and stop a Mark Zuckerberg at the beginning, it's the whole idea of the incentives. So you've got these leverage effects, these network effects with the internet. So these guys are not only making a bloody fortune only from Americans, they're making it from all around the world. That's the tricky part for me, is like, how do you, this is a kind of a double-sided conversation. We've got the individual, we've got the Fed, we've got fiscal policy, got all different kinds of issues going on here. But what's your thought about that? How do we manage something where we don't want to stop the next Bezos, we don't want to stop the next Zuckerberg, but if they make a product, for example, if I write a book tomorrow, and I've read it in 5 or 6, if I write a book tomorrow and 1 billion people want to buy my book, I'm going to do pretty good. And I'll be pretty happy that I created something and 1 billion people bought my book. But then again, if I end up with $1 trillion, I mean, that's probably not so great for the whole world to have one person with so much wealth. It's really tricky, isn't it?
Yeah, and it gets back, I hate to keep doing this, it's great that you write your book and if you sell it for 1 billion people, and Amazon and Facebook, in my personal opinion, are not unbridled social benefits that work to the greater good. They have great aspects to them and they have significant risks to them. But why do you think Jeff Bezos and Mark Zuckerberg live here, not say Sweden? Sweden actually has more billionaires per capita than the United States. But it also has a terrific transfer system. It's an equal country, and educational opportunity is shared. There are fewer barriers. Retirement is secure. In the United States, most people have nothing for their retirement other than Social Security. Health care is very unevenly distributed. If you get sick, you are at tremendous risk. This is a very different country than a lot of countries. And so yes, we can have a Jeff Bezos, but we also have a country in which 80% of Americans struggle, and we don't have a middle class anymore. People live hand to mouth, even if they're, quote, middle class, with debt.
Let me push back on you on Sweden. So I'm in Southeast Asia. Sometimes I get in arguments with New Zealanders and Australians, and I say, hey, hold on. You got a population of 25 million down there in Australia and what, 5 or 10 million over in New Zealand. I'm sure Sweden is no more than 20 million. And America is 350 million. And all of the countries that I just mentioned, New Zealand, Australia, and Sweden, by and large, they are pretty homogenous, where America is this melting pot of peoples, races, and cultures. It's the grand experiment that no one really knows if it's still going to work.
We've been doing this for a couple of 100 years. Personally, actually, a great deal of time in Australia, and I think it's less homogeneous. Otherwise, it's really, really different. And there are a lot of reasons I'd rather live there than here, not counting the climate. It's an individual decision, but America used to pride itself on being a middle-class nation. And when I grew up as a baby boomer, we were. I went through college and graduate school without student debt in most countries, and that's not just true in Sweden. Most countries, you can get a higher education without crippling yourself with debt. The average low-income millennial with student debt owes $372 more more student debt than his or her income. They have a very difficult time accumulating wealth.
They're almost guaranteed to not accumulate it with that kind of debt.
Yes.
They're damned almost.
That's my point exactly. And that is a unique aspect of the United States. It's not true of Canada. It's not true of most other countries. We are, and that's again why by any measure, whether it's the OECD measure, the World Inequality Database, or lots of others that I respect, the United States of advanced economies is by far the most unequal and getting more so very, very fast.
Let's talk about rates some more, because rates are really, I mean, look, I can think back to being a kid, and it was kind of exciting to get that first savings account. Even if you only had like $20 in your account, you thought it was really cool that you could get some interest or something. I just can't imagine anybody today who's 15, 20, 25. Do they even have a reason to understand what interest even is?
Actually, this is one of the, I think, the sort of tragic things about how hopeful a nation America is. Middle and lower income people do save. They try. They have very tiny savings accounts because, as I said, they live hand to mouth. Up till you get to 60% income bracket, Americans have far more debt than income, and people float everything they can on debt, and often very expensive debt. The Fed's view has always been that ultra-low interest rates are good for lower wage workers because they spur employment. First, that simply didn't happen. I think I know why it didn't happen, but it's indisputable that that did not happen from 2010 till 2018 in terms of real inflation-adjusted low wages. But secondly, there is absolutely no way any family without disposable income and the capacity, either the willingness to speculate in the cryptocurrency market, because I don't think even advocates of Bitcoin see it yet as a reliable retirement savings account. It's let alone an emergency rainy day fund. It's an investment. Unless you're willing to take tremendous risks, no American without access to the financial markets or who already owns a home has long-term financial family security and the ability to retire with anything other than minimal Social Security payments. That's a very dangerous situation in terms of economic fragility, because the more money you pour into the stock market at these high leverage rates, there's a lot of money in financial markets chasing yield, taking terrific risks. And that actually is one of the things that 2021 has in common with 2008. My husband, bless him, at the time looked at the markets, as did some other people who knew markets, and said, you know what? This makes me nervous. The yield on Treasury securities, risk-free, is less than the yield is less than the yield on the return, the risk premium, on a AAA tranche of a subprime mortgage debt, which is a whole lot riskier. Investors wanted those AAA subprime trenches that they took no money. They paid no money to get that risk. Those risk premiums were really distorted to get an extra 25 or 30 basis points. And we see that right now. The risk premium on high-risk investments is tiny.
I agree with you in the sense that I want to see rates go up, not because I want to just sit around on a pile of cash and earn 6%. I mean, everybody wants that. I remember my grandparents, when I looked at their accounts in the 1990s, I was like, wow, you guys have got a muni bond portfolio at 6% tax-free. And I think if I tried to explain that to some young person today, they would be like, what? But here's the deal. If we raise rates at this moment in time, you and I know what happens.
I don't think we agree on that. But hold on, though. I'm not sure we do know what happens.
I'll throw this hypothetical out. I would say if we raise rates, if we got rates back up to 3, 4, 5, 6%, that equities probably do what equities did in 2000 to 2002 and 08, 09. So that's what I would think. It seems like this is what the Fed is betting on, that if we raise rates, we'll collapse stocks right at the point in time where boomers are retiring. Now boomers can't get interest income, so they're going to have to sell stocks off. But on the flip side, some of these lower income folks that don't have the huge salaries, for example, firemen, policemen, teachers, they do have pensions through the government. And those pensions are often invested big time in equities. So if the stock market does collapse it's going to pinch teachers, firemen, police, for sure. It really seems we're like in a precarious moment here that there's almost nothing the Fed, this is just my casual observation, you are the expert, but it seems like there's almost nothing we can do, because if we raise rates and stocks come down, then wham, bam, thank you, ma'am.
First of all, I really do disagree with some facts in that analysis, and I'll walk you through them. Secondly, I do not recommend an immediate change of rates. I think we need gradual normalization. The situation in the American economy is abnormal, and speculation is rewarded, savings is punished, investment is punished versus dividending income out. It is not a recipe for long-term sustained productivity, and it generates tremendous financial instability, and we don't need to argue about this because we've seen it. We saw it in 2002 in a little way. We saw it in 2008 in a big cataclysmic way. And we saw it in 2021. And the reason the markets collapsed in 2021 wasn't just COVID. COVID was a critical spark, but the extent of the market catastrophe was well beyond what would have happened in a resilient financial system. Many boomers have pensions, including the first responders you mentioned, although most first responder pension funds are profoundly underfunded. They're being sustained right now on yield chasing. There's a great deal of literature on it, particularly government, state, local, county government funds for teachers, first responders like fire persons, police people, and so forth. Yield chasing is a structural risk, but most Americans, including many baby boomers, do not have pensions because the United States switched. There's a big difference in the United States from Europe and most of the rest of the world. We're a defined contribution plan retirement savings system, not a defined benefit plan savings system. So people really do need to save for their own retirements, and 401ks and similar plans do provide equity investments. But even those are for the upper middle class. As I said before, 53% of U.S. stock is owned by the top 1%. So most Americans, the only way they are able to save for retirement is through home equity, which is very disproportionately owned by older, higher income households, and savings. It's not the equity markets. Even if you were right about the importance of equity markets to long-term prosperity, it's not shared in any way.
If we raise rates, though, stocks will come down.
But if they come down gradually,
if markets get a sense, whether it's real estate or stocks, if they get a sense that the Fed's going to take rates back up to 4%, we're going to have a mess coming down.
I don't agree with that. That's where I think I don't agree with you. I think you can say that. I will say just unequivocally that I don't think that's correct. If markets normalize gradually, and we have a 10% quote correction or a 20% price reduction, if that returns risk-reward premiums and PE ratios to a more normal state, people like me who are doing very well will look at our balance sheets and say, oh, look, I lost money. I won't change my consumption pattern one bit. The United States economy is not sustained by wealthy people like me because I don't need anything I don't already have. My money is in paper, and I'll do fine.
I know you want the Fed to raise rates. You're saying we can do it in a normalized way. Do you think, though, as I give you this alternate perspective, am I entirely crazy if I look at the two big 50% S&P melt-offs in the last 20 years, 2000 to 2002 and 08 to 09? You definitely looked at a situation where each time the markets collapsed, the Fed took rates down to basically zero to goose the whole system up again. What has changed in your mind to where we would not see Act 3, that if stocks, for example, dropped 50%, or if California real estate dropped like it did in 07 to 09, 60 or 70%, why would the Fed not, I guess they go negative rates. I mean, could you ever imagine negative rates?
Yeah, we have them now. Let's look at what happened in perhaps the two most recent crises, and I think it's true also to 2002 was the dot-com bust was different in structural ways. So in both cases, the markets were collapsing and the Fed lowers rates because everything was collapsing in 2008, 2021. And the idea was by lowering rates, you will restart the economy. And particularly in 2008 and much faster in 2021, what happens? The Fed drops rates. The market is collapsing before the Fed drops the rates. The Fed drops the rates in response to market collapse to stabilize it. So I think, first of all, cause and effect need to be carefully unpacked. And look at 2008 to 2010, when equity prices were indeed significantly below the level they were in 2007, early 2008, and again where they began to march up in 2010. Wealth inequality flattens because rich people lose some money. But the markets then begin to climb in 2010. Rates, again, remain low. The Fed is not changing its interest rate policy. It's not changing its quantitative easing. The markets begin to recover, partly due to significant amounts of fiscal stimulus in 2010. Then the equity markets begin their enormous upward climb while rates stay very, very low. The Fed starts to try to raise rates in 2018. The market trembles. It corrects about 3%. That's all. Fed gets spooked by that, lowers rates again. The markets begin their ever upward climb and risk-taking. And then you have 2021. That market crash was so short that there's no data on it, because the market began its upward climb literally within 2 to 3 weeks. In the United States, we have record unemployment, 14 million people out of work due to COVID in April, and the S&P 500 has its best day since 50 years. So the markets and the real economy are dissociated because of the risk premiums, distortions due to ultra-low rates, and I think it's very important also to remember the Fed owns a quarter of the United States economy with its giant portfolio. It owns about $7 trillion of assets now, and by the end of the year, it's likely to own 10. That changes the way the world works, too.
It is a situation that I think for the average person, they look at the last 20 years, if they're perhaps my age, your age, or even a younger person, they look at the last 10 years, they're going to look at things a little bit different. And I think people, they don't really trust or believe that the people that are at the controls know what they're doing.
Well, why should they? They don't. Look at what's happened. This is why in my book I have a couple of chapters about how unequal, and just stick to America for the moment because we are the most equal. As I said before, you can work really hard and you don't get ahead anymore. That's not fair. And it's not about people being lazy or people being dumb or people being, for racial or gender or other reasons, just unable to succeed. It's not that. The system isn't working for people trying hard.
You think about these issues a lot. Let me keep you at the philosophical pushback for a moment. Let's say that the Fed does what it does as you describe, and these folks don't look like they've got best decision-making skills. Perhaps for their own self-interest, they do. Perhaps
I like them a lot. They're really nice, really smart people, but they buy into economic theories that I think are very outdated.
Well, here's the thing, though, is that you and I can imagine ways where things can be improved, but I just don't see any of that in the last 20 years. And so I wonder, as we talk about ways that the Fed can do better, the average person, though, it sure seems like if the average person wants to get past some of the issues that you're talking about, for example, inequality, that perhaps the last place they should be looking with the limited time they have on this planet, there's no life extension yet, it seems like the last place we should be looking for assistance is the Fed. Because otherwise it's just kind of like wishful thinking in a way. Like it almost seems like we need to kind of pivot and just imagine that this Leviathan is going to do what it does. But if we want to get ahead, we got to do something outside of that.
I don't agree with you, and I'll tell you why. When you look at the causes of inequality, economic inequality in the United States, they're complex, and many of them are structural. They are the educational system. Let me just stop there, for example.
What do you mean by that exactly? My audience will want to know. Half my audience will agree with you immediately. Half of them will be like, what does she mean?
There are aspects to inequality. I'll get back to financial policy, monetary and regulatory in a minute. But just think about one proven cause of economic inequality is education. The primary schools in lower income neighborhoods are demonstrably less capable than schools in upper income neighborhoods, let alone fancy private schools and all the tutoring and so forth. That wasn't true, by the way, when I was a kid. Sure, because again, I'm a baby boomer. Public schools were not necessarily as good as private schools, but many of them were better. And most schools delivered a competent education with relatively equal achievement rates. There were major differences based on race, not major differences based on income or neighborhood wealth. That's, of course, not true. So let's assume we have an epiphany, and the policymakers in federal and state education departments wake up and they completely do something, some master stroke that reverses everything, whether it's the pre-K education that the Biden administration hopes to get through Congress, and that miraculously works. It'll take 25 to 30 years before those kids achieve the levels of education necessary for them to achieve also economic income opportunity. By that point, because again, my book is called Engine of Inequality because that's the exorable way inequality works. In that generation in which educational achievement equalizes miraculously as kids go from kindergarten through college, their families will get poorer and poorer. Now, you can change tax policy, impose a wealth tax. That will help. It may have, I think it'll have some structural adverse results on aspects of innovation that you described or productivity, but certainly we could, in the United States, we could have a more progressive tax system. We could have a more progressive retirement system. We could do a lot, but it will take a generation or more to work its way through. If you change monetary policy, that will work in a year to two. It's not the whole solution. I'm not in any way suggesting that the Federal Reserve epiphany and an understanding of how current policy makes inequality worse will make America equal. A Fed epiphany and more equitable financial policy will make America less unequal very quickly and give the other policies we also need time to work.
But is your analysis and what you just described, I'm the guy just kind of listening in, it sounds like giving money to people.
No. It sounds like what I again would call normalizing the economy so that productivity, what I mean by that is productivity is rewarded and savings is rewarded. You create new incentives for companies to invest, build factories, and a lot of that is interest rates and market phenomena. It is much more lucrative right now to own a company in which the profits are instantly generated back to you as an investor in stock repurchases than they are if a company is willing to take the time and buy new plants and facilities. And one of the reasons, you just see the market is very distorted in the United States with significant decreases in productive capacity because that's where financial policy makes decisions. When a board of directors sits around and looks at the company and says, okay, ladies and gentlemen, what do we do with the money? How will we make it quarter over quarter returns to keep the markets happy? And right now, the answer to that is always double down in stock repurchases with minimal investment in long-term productivity.
Let me add this to get this even more complicated. As you know, I'm in Southeast Asia. And so if I want to hire an assistant, I do not waste my time in America, okay? Because there are plenty of productive, in fact, more productive, working at perhaps 50 to 60% less money in the Philippines with great English. This gets back to my whole internet point starting in 1995, that we can attempt to look at America in isolation, but there are many factors going on. Look, Americans love to shop on Amazon. I do when I'm in the States. My father's got an Amazon box coming to his house every day. Americans love cheap plastic stuff made in China because they've got factories in China where people make cheap plastic stuff. But Americans don't want to work at factories making cheap plastic stuff.
Whoa. Hold on a second. America also doesn't want a nation with no environmental controls. It's just more complicated than that. We are a more expensive economy to manufacture, and partly because we have environmental controls. We have a minimum wage. There are a bunch of other things going on too.
I'm not disagreeing with that, but the reality is what I just said, which is there's no manufacturing in the States because it's cheaper to do in China, and every American corporation knows that, right?
It's complicated. If you change some of the market incentives, right now there are no incentives to counter those environmental costs of doing business here. And some of that is tax policy. Again, it's much more tax efficient to take on debt than invest. It's just the way the United States works. Look at all the investment the Chinese government put into broadband. Look at the difference between that and the United States. I mean, there's a huge amount of state infrastructure across Asia, and we don't have that in the United States.
I mean, doesn't everybody that wants to have access to broadband in the States have it?
No, absolutely not. You need to come back and take a look outside where your parents live. No, that's just not true. I mean, in the United States last year, when we went to remote education, have to go to remote education, suddenly in the United States, 30% of the District of Columbia students disappeared because they had no broadband capabilities in their homes in the District of Columbia. It's not even just rural. It's here in my hometown. We lost 30% of the students and 70% of the students of color in this city, not because their parents didn't want the kids in school, but because they didn't have broadband capacity, digital capability in the city, the nation's capital.
Let me keep it at China for just one moment. This idea of manufacturing. I think for most people, whether it's a small 6-member company or a very large company like Apple, everyone knows that you can come over to Asia somewhere, China, Vietnam, you name it. Nike's made hundreds of millions of shoes in Vietnam. There's a reason for that. Regardless of how it happened, we're there now. So if we were to, as you were kind of saying, if we were to get manufacturing to come back to the States, well, it's just three-dimensional, right? Asia's not going to roll over. So we would have to do what? Create tariffs to make the cheaper stuff coming from Asia up to a level where our people can manufacture and compete?
Maybe we could make better quality stuff.
But Nike and Apple makes pretty good stuff in Asia already, don't they? We're all buying it.
Yes, well, some of it is, some of it isn't. I buy a lot of stuff because I'm old. I look at the quality of garments that I had 15 years ago and the material in them and how well they lasted, and the stuff I'm buying at high prices now and how much less well-made it is. Let me just, please, if I may, return to, because we cannot solve all these problems. We're not going to solve globalization. We're not going to charge the broadband digital capacity. We're not going to charge the educational system. I know I can't solve everything, and I don't think we can on this podcast because we'll be here for weeks and we still won't be able to do it. What I think I know after a lot of nights and weekends working on this, I didn't need to write this book. I have a day job and I'm a nice life and I'm doing fine. I wrote it because I think the economic inequality in the United States is so bad. It is, I've seen it in our last 2 elections. This is a very angry, increasingly self-destructive country because you said it correctly. People are angry because the system isn't working for them. Well, how do we do incremental small things? We need a lot of big things. But the government is so dysfunctional. I don't think we're going to get many big things anytime soon. Can we do something small that will make a meaningful difference? And the answer is yes. And the way to do that is to fix the Fed. Is that the whole answer? No. Will it deal with where do I get my sneakers from? No. But it will change critical issues like making it more sensible for families to save in a financial market that is less speculative, and that will make the economy more productive over 2 to 4 years. And that's the only way I know how to do that.
Let me keep you at something as we wind down. This idea of digital currencies. So we can start with something like a Bitcoin. It's all the rage and up and down and all kinds of stuff. I heard about it for the first time in 2013, and I guess I should have bought it when it was $200 or $300 when my buddies were telling me about it. But it's surely not a currency. When Elon Musk can make the market move 20 or 30% in a day, that's not a currency. It's a great speculative investment for those that have been on the right side of the train. No argument there. But speak to this idea of digital currencies, because look, in this part of the world, regardless of what happens in the news, there's a lot of people around this world that like to have fresh, clean $100 American bills. They love that stuff. That is gold to them. Gold is better to them, but those fresh $100 American bills, when people say
they're lighter, you can put it in your wallet. The gold is harder to carry.
When people say the dollar is going to crash and all this other kind of stuff, anything can happen, but the numbers of people around the world that believe in the dollar as a reserve is just, you see it at a very tangible individual level, is really strong. But let's open this up a little bit in our limited time left with the idea of digital currencies. And what is your thought?
You said a minute ago, I think correctly, that if Bitcoin, when Elon Musk can make a sort of bad joke on late night TV and the value of a currency drops 30, 40%, it's not money. Money is well defined by being two things: a storehouse of value, i.e., I can put it away now, and in 30 years, I will have something on which I can retire, or if I save it now, in 6 months, I can buy something I want with it. That's a storehouse of value. If I save it for my children to inherit, they will inherit something. Bitcoin's not that. And then the second thing money must be to be of value is it has to be an efficient, reliable medium of exchange, that I can get what I want with it, even if I deal with somebody I don't know. And I think by all of those criteria, there isn't a digital currency yet that has accomplished the value of being truly money. Some are maybe beginning to get there, and there's a huge amount of discussion of central bank digital currency. But that's a very important evolution we need fully to understand. And I think those of you in Asia are particularly conscious of the fact that China, for example, may well prove to have the most efficient digital currency in the world more quickly than anybody else through its central bank. But is that going to be private, or is that going to be part of a new social credit system in which yet another facet of individual behavior is monitored and controlled by the state?
That's frightening, huh?
I think so. And I think the United States, we've just had a tough 4 years.
If the value of your money is tied to what a bureaucracy or a government can judge based on your behavior, some behavior that they deem that they like or not like, that's frightening.
Yes, and that's why I think we need to think really hard. It's a vital question. It affects monetary policy. It affects regulatory policy. Who are the institutions who control our economic life? Banks are not temples of virtue, but they're regulated, and they pretty much do what they're supposed to. If you give your bank in most countries your money, particularly in a country like the United States with deposit insurance, you know you're going to get your money back. If you give your money even to an established provider like, say, PayPal, there is no guarantee your money will ever come back to you. It's a wholly unregulated system. And we need to think pretty hard about that before something blows up.
What would be the rationale for the Fed to create a digital currency? It seems like to me right now, okay, I've got access to the dollars that I have in my life, and I've got those dollars in assorted banks. And to get those dollars out, I can go to an ATM, I can use a credit card. It seems like the system, whether or not it's a perfect system or not, I don't have any issues in my life that it seems like I can't use and manipulate currency to buy and sell and to move currency around. I would say, of course, wire transfers amongst banks is clearly bureaucratic on purpose, and that could be cleaned up. There's been apps that have been developed like TransferWise that get around the bank system to some degree and make things more efficient with ACH transfers and whatnot. So what would be the rationale for a digital currency from the Fed?
There are two, and they're compelling. Once you get past the slogans and things, I support that, you really need to think about what would this mean in practice. And the reasons why progressives, and particularly liberal Democrats, are pushing for something they call Fed accounts are twofold. One is that while you are able to access your money and your credit cards, your ATMs, the fees involved in that in the banking system are high. The access to it, particularly in rural parts of the country and urban areas, low-income urban areas, don't have bank branches. They don't even have ATMs. People use check cashing services and payday services and other neighborhood liquor stores, for example, at much higher risk, higher cost financial services. There's what's called friction in the delivery of those financial services. And secondly, it's slow. We don't in the United States have instant payments, and the Fed has been incredibly slow talking about that, let alone cross-border payments. The Fed started talking about faster payments in 2013. It only in 2020 announced what it now calls instant payments, real-time payments for retail transactions like yours and mine. And the soonest that is going to come into effect in limited ways through some banks is 2023. And we have a private payment system that is delivering real-time payments through the parts of the banking system much more efficiently. But the liberal Democrats don't trust that because they go back to that access point, the friction point, and are very concerned that lower income households won't have access, especially immediate access to their payments. Those are the reasons why people want digital currency. They want universal access and they want speed.
You've mentioned several times in this podcast, and I'm not discounting anybody's particular station in life in terms of income. I can walk the streets of Saigon and I can see 80-year-old ladies selling fruit, hustling like crazy. There's no welfare system in Vietnam. But look, I grew up in Northern Virginia. It's kind of the suburbs. A lot of people in America live in the suburbs. So a lot of people in America are not necessarily worried or imagine that they want to see massive amounts of government time and money spent on some of the things that you've just mentioned, because it's not something that they worry about in their daily life. That's part of the problem in America, isn't it? That you've got so many different tranches of people, so many different classes, so many different statuses, not just only the super rich. Suburban people don't worry about their ATM cards. They can use an ATM whenever they want. They can use a credit card whenever they want. So I think
hold on. I mean, people really do worry about that because if they use an ATM from another bank, they can pay $6 to get $30 out. The fees, people do worry about that. Bank fees, whether they should worry about that, whether the fees are as high as they are, there's a lot about the banking system that challenges middle-class households. It's one of the reasons I talk about how to change the banking system in my book. It's not just the Fed that needs to change. We need to change aspects of the banking system, too.
There's no disagreement that somebody taking out $30 should not have to pay $6 in fees. I think for people listening to this conversation, they can see the two sides of the pushback. I'm giving the rugged individualist approach. You're coming at it more from a macro government perspective.
No. I think you're giving the rugged individualist, someone not living in the United States and relatively well-off approach. I have to say, I don't think you've been here enough outside of Northern Virginia. The country isn't McLean. It just isn't.
Lived around the country in different places, so I look,
yeah, but you have to live here. It's just not like that. It used to be. In the 90s, this is a different country. And it's not what I thought it was going to be in the 90s. It just isn't. I wish it were.
Every time I've come back twice a year for the last 7 or 8 years, I see more economic development. I see more building. I see the stated unemployment rates. I see the stock markets up. I think the one thing, though, where I think we can find agreement on is the rate policy. The rate policy is what drives me bonkers. You can't trust the system if the rates are rigged by unknown players rigging the rates for whatever reason that the average American cannot understand why those rates are rigged. Fair?
Yes, but I think even so, if you go to Crystal City, you go to Pentagon City, you go out to the high development Loudoun County parts of Northern Virginia, you will see what you think you see. If you go to pockets of Alexandria, if you go to Springfield, if you go to Prince George's County, Gaithersburg, Maryland, you will see something different, let alone Southeast D.C. It is different. And one of the reasons you see what you see in Northern Virginia is because of gentrification and hollowing out. And you see two-income households. Middle-class wages in the United States in real terms have been flat since 2001. So families now have two incomes, and debt burdens per family are hugely higher than they ever were. You will not see that unless you are that.
But everybody wants a McMansion. Everybody wants their kid in the best schools, right? I mean, that's...
No, you know what? That's everybody. You know, a lot of the people in America were standing in food lines last year trying to figure out how to get their kids in school. That's 40% of this country. They don't want a McMansion. They want to be able to afford a 2-bedroom house, which they cannot. Housing prices in this country are unaffordable for all but the upper middle class.
Let me draw that Maginot line between us. So when I say rugged individualist and you give me some pushback and say, well, you know, well-off guy in a foreign country, okay, fair enough. But ultimately, if the system, this would be the pushback for me, if the system is such that it's not working for somebody, as far as I can tell right now, there's no life extension. So if you are an individual that's in a position, as you're describing, where the inequality is clear and that family, that individual is stuck, it does seem like that if the Fed, and I know, look, you've given a great policy proposal for the Fed to take action, whether or not it's going to happen, I don't know. That's why I'm saying what I'm saying right now. It does seem like that ultimately the individual has to look at this whole scenario differently, in the sense that just trusting there's going to be a job there, trusting that the government's going to do the right thing, and trusting the Fed's going to do the right thing is a gamble. It's almost like being in Vegas to believe it's going to happen.
People don't. That's why they voted for Donald Trump, because he told them he would fix it. Had he not bungled the COVID crisis so much, he might well be president today. People are very angry. It's one of the reasons why in my book I call for incremental solutions, because if we make things a little better, maybe we will give the political system a little bit more courage to make some of the harder decisions. The Fed isn't part of the political system. Why I focus so much on it in my book, and why I think one of the reasons I'm optimistic, is the book is getting traction. People are reading it. They're seeing that there is indeed an engine of inequality, and that fixing it will help to improve wealth in America. And if we start to do that, we can start to do other things. Raising interest rates gradually, but meaningfully, so that savings is no longer a sucker's game. Corporate investment becomes gainful again. We can make small changes. The whole answer? Of course not. But this country is not about rugged individualists who are doing great things for the rest of us.
It should be, though, shouldn't it?
Of course it should be, but...
It shouldn't be lemmings waiting for somebody to kind of like be daddy to them. I mean, we've done a lot of welfare since the Great Society, right?
I don't agree that people are waiting for daddy. I think that's a rather unfortunate paternalistic view of the United States. People are working very hard. Low-income wage families are working, most of them, 3 and 4 jobs at paupers' wages. They work very hard. The system does not permit them to get ahead. I know a lot of recent immigrants to this country. My husband and I used to tutor low-income kids. They're not deadbeats.
I don't think anyone's a deadbeat. I just think that
Well, you said people were waiting for daddy, and I think that's not a very appropriate way to talk about most Americans.
Well, there's a lot of people that don't like the American welfare system. I'm in a country where there's no welfare, and I see a lot more hustling in Vietnam than I do in America. When you see 80-year-old ladies on the street selling fruit, this is a complicated thing.
Is that a good thing or a bad thing? Do you like that better, or would you rather have 80-year-old ladies? How many 80-year-old ladies who are indigent? Fortunately, you have a family system in Vietnam, and perhaps they're being looked after by their children. But what if they're not? Who takes care of them? In the United States, is that a welfare system, or is that as you criticize Sweden, but is it perhaps not better that people who are unable to hustle on the streets are still able to eat? Which would you prefer?
Well, we do have a situation in America where the welfare transfer payments go to what percentage of America? It's a very high percentage, close to 50% or over 50%.
Nuh-uh. That's just factually not true. Transfer payments in the United States go to people like me. I get Medicare, I get Social Security. Lower income people, the bottom 40% of the Americans in this country, pay more in payroll taxes than they get in transfer payments back to them in terms of Social Security and Medicaid. It's not true. You just look at the aggregate, say 50%. That's one of the mistakes the Fed makes. Don't look at raw numbers. Look at who's behind those numbers, and I think you'll see a different country.
So when I say that an 80-year-old lady is hustling or selling, that's not to denigrate anybody, the 80-year-old lady that's denigrating or hustling. But, I mean, I think it's a fair debate There's another factor we didn't talk about in America right now, which is COVID. This is back to the individual part. I mean, America's a country right now, when it comes to the individual, if we look at something like obesity, we look at healthcare costs. The reason that healthcare costs in America are so high, one of those reasons is individual choice to be.
No. We don't have time for this. America also doesn't regulate drug prices. Almost every other country does. United States, there is drug prices, and it's a lot more complicated than that. It just is. And one of the reasons we have obesity rates in this country is there's a scant 40% of kids in this country go to bed hungry. And what they eat is crap. And there are food deserts across Southeast D.C., Prince George's County, and much of America where there are no fresh fruits or vegetables. People eat garbage because it's cheap, and it's the only thing they get. And you go to a food pantry, look and see what food pantries hand out to poorer people, and you wouldn't eat it because it's really not good for you. It's day-old donuts. But if you're hungry, you eat it.
I like this kind of a conversation because it's definitely two views of the coin. And ultimately, I think anyone listening does realize that the prescriptions here are a little bit more. I'm coming a little bit more from the individual side. If the big government can't do it, then people have got to make other choices and not try to think about the cavalry coming to save them. You're kind of looking at it saying, well, hold on, I think we can make some fixes here. I think both sides are legitimate in terms of debate and discussion.
Oh, absolutely.
That is one of the problems we have in America, though, because we can't have that conversation. How many times do you hear the conversation that you and I are having, unless it's name calling or something terrible, right? Right?
Oh, no, absolutely. You could not be more correct about that. And I'm enjoying this immensely. I really am.
You push me, I push you, and we could probably push each other for a lot longer. People would probably enjoy it, but I'm just saying that is the nature of this. I'll give you, there's a lot of things that I've seen done in Vietnam that are a heck of a lot better than the way we do things in the States. And I'm sure there's a lot of things in the States that are done better than in Vietnam and China. But great stuff. We could keep chatting forever. Engine of Inequality, the Fed, and the future of wealth in America. The future of wealth in America is a hotly debated topic, as listeners today can hear, huh?
Reasonable people can differ, and I've really enjoyed differing with you because this has been, as you rightly said, a great conversation about, I think, one of the most important issues we really need to talk about reasonably and then take action on as quickly as possible. It's been a great pleasure.
Where can we send people? Where would you like to direct them to? Website, or where can they find you?
Well, they can find me at info@fedfin.com. That's info@F like Frank, ED, F like Frank, IN.com. My day job is as managing partner of a company called Federal Financial Analytics. So that's the best place to contact me, is through the info site for my company. There's also a book page there where you can learn more about the book.
Karen, thank you very much.
Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.